Hey, I'm Zach, a truck driver aiming to retire at 44 and travel the world. After bankruptcy in 2016, I rebuilt my wealth testing 5 strategies: the 12% Solution by David Allen Carter and Jason Kelly's 4 strategies, the 3 SIG, 6 SIG, 9 SIG, and most recently, Income SIG. I've shifted to one core plan for FIRE. Want to know why? Let's shift into gear and dive in. When I was about 30 years old, I worked for about a year as a financial advisor. I really loved studying all different kinds of investing. I liked to look at studying the charts for ways to know when the market would go up or down, and I looked at studying individual stocks and options, and I traded with real money with all of those different kinds of trading methods. But then, after years of doing that and me thinking I knew about money, I had to start over in 2016 with my bankruptcy. As a truck driver, I really needed something simple and a proven strategy to be able to hit financial independence by 44. I tested the 12% Solution by David Allen Carter and Jason Kelly's 3 SIG, 6 SIG, and 9 SIG, and Income SIG more recently to find out what works for my FIRE journey. Let me add real quick, as far as chart trading goes, if you're trading based on the charts, you're really just guessing. Yes, I am saying that. I'll be that blunt about it. You might be successful for a little while doing that, but that success is luck, not skill. And anyone that tells you otherwise has not been doing it long enough. Let me not forget to add that this video nor any of my videos should be considered financial advice. Please do your own research. Even though I was a financial advisor and I am giving tips about money, this is not financial advice because this is not specific to you. Everybody's needs are different. And unless I spoke with you as an individual and worked with you to make a full financial plan, I would not be giving you financial advice. If I say that I'm buying fund XYZ, that may or may not be for you. And it may be for you today, but maybe not tomorrow. So because I won't be there to hold your hand, this is definitely not financial advice. Jason Kelly's The 3 SIG plan is a low-stress plan targeting 3% quarterly growth. You put 80% in a small-cap ETF like IJR and 20% into a bond ETF like BND, and rebalance every 3 months. For example, with $10,000 in the stock fund, you would aim at the end of the quarter for that to grow to $10,300. If stocks hit $10,700, you would sell $400 worth of those stock ETFs and buy $400 worth of the bond ETFs. If, on the other hand, stocks were to drop to $9,800, you would buy $500 more of the stock by selling $500 of your bond funds. It's just 4 trades a year. It works in your 401k with an index fund, or in your IRA with an ETF or index fund. And you keep the taxes low in a taxable account by only trading a few times a year, and you usually don't have to sell all of your holdings. It's perfect for FIRE. Over the last several years, I was investing in the 12% Solution, which uses monthly ETF trades based on momentum, aiming for 12% annual returns. So it is essentially aiming for the same annual performance as Jason's 3 SIG plan. It was promising, but it had up to 12 to 24 trades per year, racking up expenses and taxes. Every month, there was a possibility the plan would call for you to sell all your holdings and buy all new holdings. This can be costly in a couple of ways. Most brokerages nowadays don't charge trading fees, which is good, But if you're in a taxable account, then you're still going to be hit with the short-term capital gains on these shares if you had a profit, and that can add up. In addition, every time you trade in and out of something, you have what is called slippage. That's where there's going to be, no matter what you're trading, whether it's a house, a car, anything, there's always going to be a difference between the bid price and the ask price. And even in like modern day popular ETFs, that can be down to a penny difference or even a fraction of a penny difference between the bid and the ask. You're still going to be paying that price essentially, even though you don't see that as a charge on your statement. It's not a fee per se, but it is slippage every time you trade. And that's why a lot of active traders don't remain active traders for long. Most long-term investors recommend buying and holding. Jason Kelly's plans only trade quarterly, only 4 times a year, and it's not going to be recommending buying or selling the whole position at once. Just little adjustments here and there, up or down a little bit to adjust based on what happened in the most recent quarter. But in the beginning, I liked the 12% solution because it was more hands-on. It made me feel like I was doing something, and if the market started to crash, the plan would call for me to move to safety like cash or short-term bond funds. Along the way, I also split my portfolio across Jason's 3 sig, 6 sig, and 9 sig, targeting 3, 6, and 9 quarterly growth. The 6 and 9% signals, those plans really boosted my net worth in bull markets, but they were very, very volatile. And you cannot do those plans in your 401k because the 6 sig and 9 sig plans, they require you to use ETFs that are 2x the market returns and 3x market returns. So you're not going to find those ETFs in your 401k. 401ks are more for long-term buy and hold strategies. Now that my portfolio has grown to almost $1 million, my wife and I have decided to cut out the 12% solution from our investing, and we drastically reduced our investing in 9 sig. We have started using Jason Kelly's income sig plan, which focuses on cash flow over growth. My current portfolio is about 40 to 50% overall in Jason's income sig plan, with the other 50 to 60% being divided up equally among 3 sig, 6 sig, and 9 sig. Each of those account for about 16 to 20% of our plan for growth. We plan on gradually dialing that back for 3 sig, 6 sig, and 9 sig as we gradually increase our allocation to income sig. Of course, if the market does have a drastic and sharp downturn, then we can jump back into 9 sig at that time and be aggressive once again to really help boost our performance again. Now, in recent years, Jason's 3 sig plan has underperformed the market, and it has underperformed the 12% solution by David Carter. However, I believe that the 3% solution will go back to outperforming the market. In recent years, the smaller cap stocks have been hurt a lot by the pandemic and tariffs, and larger cap technology companies like Google, Facebook, Apple, they've been making a lot of money with all of the new AI chips. But I do believe that small companies will find a way to become more profitable again, and 3 sig will catch back up and surpass just investing in the S&P 500 or VOO. So I do plan on continuing to invest in 3 sig, but it's only a small part of my portfolio now, as more and more of my portfolio will be in income sig. Let me go ahead and address some of the criticism that both Jason Kelly and his 3, 6, 9, and income SIG plans have come under fire with over the years, as well as David Allen Carter and his 12% solution. Online, you can find people criticizing these plans for cherry picking the data as far as when they did their back testing. But having followed these plans for years and read both of these authors for years, I can tell you that they are not cherry picking the data. They've gone back as far as they can with the data that's available to them. You can read their books, which were published over 10 years ago for the 3% signal. But even before that book was published, Jason was writing in his weekly letter about the plan and using data as far back as he could research. And I can tell you that using real money, that the plans do in most time frames outperform the general stock market, but not in all time frames. You can always find different time frames when one plan will do better than the other. However, the value of both of these authors' plans is that they will help you keep invested by keeping your emotions in check when the markets go crazy, when you feel like it's going to keep dropping and dropping. The plans will tell you when to buy, when to sell, and how much to buy and how much to sell. And in my opinion, that is way better than trying to pick individual stocks or trade options or just buy and hold an index fund and hope for better days. These plans have built-in mechanisms, which I can go into further if you like in future videos, built-in mechanisms which will tell you to buy more and hold more when the market has crashed. And they will also tell you, when the market is going up, when to sell and take the profit. So if you want to see more in future videos, I will also be going deep into detail about exactly what holdings I have and what accounts they're in and show you dollar for dollar what is in each of my accounts. So who is the 3% signal for? It's for anyone wanting low effort, tax smart growth, especially with the flexibility of using it in either a 401k where you can get your company match, that's always good, or your IRA or taxable brokerage account. Income SIG is my retirement bridge, while 6 and 9 SIG are going to add growth through my retirement years. Testing 5 strategies taught me diversify early. Simplify, though, as you get into retirement. Have you tested multiple plans like me? How's your FIRE journey going? Share below. I read every comment. Subscribe for more free FIRE tips and stay tuned for updates on my 3, 6, 9 and income SIG portfolios. Last but definitely not least, don't forget to hit that subscribe button so we can continue to drive towards financial freedom together.